Welcome back, folks. Hope you had a pleasant week. And I'm going to be returning back to our daily presentations. Before I get into those, there will be a video on Monday for the daily log entry and price action logs. But I'm going to be testing PDFs as a alternative to daily videos. There's a lot of videos coming, and you already have a lot each month. So I'm going to make it so that way the daily log entries are PDF, and I'll include little notes on how you can improve, looking at price and reading price action. So that while they're not going to be heavy lessons, but you'll get clearer pictures. Okay, you'll get better resolution on the daily log entries than you do with what I show you now. Plus, it's going to save me a lot of time because I do lots of videos, and I want to do most of my video work on the midweek review and the weekend lecture. Okay, so I want to kind of preserve all that time for the big lessons midweek and end of week. So, like I said, Monday we'll have a regular video, and Tuesday, Thursday, and Friday will be PDF only. Okay, so there won't be videos, but you'll have the equivalent of a video, but you'll have it in a quick downloadable thing that you can carry around with you and study it. You can zoom in real good. It'll be good for you to have them. A lot of you have been asking if you can print out screenshots for your journal. And yes, you can do that. But I'm encouraging you also to make sure that you have your own annotations. So you're testing yourself, not just taking mine and putting them in your study journal and pretending they were yours all along. You're also going to notice there's going to be some extreme watermarking in the PDFs because I've caught several people making books out of my charts and such and selling them on Amazon. So I have 2 pending lawsuits with copyright infringement with Amazon, and those individuals will have their books taken down as well. But nothing obviously too offensive, but it'll be very clear to see where these charts and things are coming from if they zoom in or whatever. But nonetheless, I want to pick up with the lesson that I gave you, which would have been on your Wednesday or Thursday video. At the time of the recording, I don't know exactly what day I'm going to give you that first lesson, so it's already in your hands by now, but nonetheless. We're on holiday schedule, so we're going to continue with part 2 with institutional order flow in indices. All right, I gave you homework with this price action right here. I told you to focus in on that little area right there and do the same thing I outlined in the previous lecture. So we're going to take that area there and break it down and see what it shows. That was your homework. All right, so now we're back at that S&P 500 chart, and this is an hourly chart, and this is the framework here. Buy side liquidity up here, sell side imbalance, buy side inefficiency here in the form of a fair value gap. We have buy side liquidity there, which it ran through and trades up into the fair value gap. But I want you to take consideration of what allowed the market to run here. And before I do anything with annotations, pause the video and consider what was likely as a catalyst for that price run. Okay, if you haven't paused, I'm about to explain in further detail. So if you take a look at what the market shows there, you have all these consecutive up close candles. This inside the narrative of this low and lower low, this is the highest high in between this low and this lower low. So you have to take all of this as part of the underlying context that the algorithms, which yes, there's an algorithm that prices E-mini S&P futures now. They're all electronic markets now. So they're going to be manipulated, they're going to be controlled. This whole business here, this 1, 2, 3, 4, 5, 6 candles up, this entire range is your bullish breaker. Okay, so you have all of this area here that you can find a trade in back over here. You don't need it to trade out of the breaker and then come back down in for it to be useful. Now I taught, and if you have just recently started, you'll learn this also, but there's a concept of PD array matrix, and then also looking at a range and defining it from premium to discount, and which PD arrays you look for, and working within that context in an underlying narrative, basically in layman's terms, when to be a buyer in a bullish market or when to be a seller in a bearish market. And it's defined very specifically, not ambiguously like most retail concepts are. So I want to be a buyer in here. So how could I frame that? We can take a closer look inside of that range. This is your bullish breaker range. So that's your range. You don't need it to leave the range yet, because the underlying context is we came down here to take stops, so it should be underlyingly bullish, reaching for that 4,000 level that I mentioned in the past. We have this area up here, and we have this area down here, and the equilibrium between this candle's high, this candle's low of the breaker's range. So once you have that range, you're trading inside that range with what bias? Bullish bias. So there's buy side liquidity here. We can trade up into the fair value gap and maybe even up into that buy side liquidity. When the market trades down here, and while it's trading here, it's in what? It's in a discount market. It's not in a premium relative to that bullish breaker that we have not even left yet until this candle. So I want to take a look at what frames this whole business here and drill in to that small little range right there. That candle sets up the study. This is the order block that you're going to see when we drop down into the 5-minute chart. Bullish order block inside of a discount market with the narrative that it's likely to go up into the fair value gap, run buy side liquidity, potentially up even here, and as much as 4,000 or thereabouts on the daily chart for S&P. So we're looking at the 5-minute chart now for the June contract for 2021. This is that same shaded area here. And I'm focusing your attention right there. And this is that order block from the hourly chart. And this is that equilibrium level. So everything's framed out. You can keep the proper context in mind. This is that first buy side liquidity pool. This is the discount level low on the hourly sell side imbalance, buy side inefficiency. And this is the premium high of that same 60-minute CIVI, which makes up the fair value gap. If we take it just at face value like this, it's not that helpful or useful to us, even though we do have an order block. And yes, we're taking out sell side liquidity here. And if you take these two consecutive candles here and look at it from a 10-minute perspective, this would be an imbalance, which it trades back down into here for consequent encroachment there. So there's several things occurring, but I want you to take a look at this chart if it were made into a line chart. Okay, so you go in, you right click your mouse on the price action as a candlestick chart, then select settings, and then change the settings to a line chart. And then you can make it also show the price source on the line chart as the low. So what we're plotting here is the lowest low of every 5-minute candle. That's the reading it's posting here. And when a new candle opens up, whatever the lowest reading was for that candle is what will be plotted here on this line chart. Now we're going to add the Dow, which is YM symbol, and M for June in 2021. And again, you're plotting that overlay using the compare tab on TradingView. You've seen me do this before, and you'll probably see me do it again next week with more examples. But you click the compare button on TradingView when you have a chart, and you can overlay another chart. We've done this before. And entering in the symbol YMM2021, when you do so, right click on it, make sure it is showing price source at the low, and you can make whatever color you want it to be. And you can see the Dow futures is overlaid with the E-mini S&P futures. And now we'll do the same thing, comparing, hitting compare tab on TradingView, adding NQ, which is the NASDAQ futures, M symbol for the month of June and 2021, and again plotting it as a line chart with the price source at the low. So what we're doing in this area here, we're comparing and contrasting the relative lows. Not relative equal lows, the relative lows. So this low is relative to this low and this low, respectively. This low is relative to this low and this low, respectively. But it's kind of hard to see it like that, so just for your benefit, let's strip it down. In this area here is where our focus is. We're going to take away the Dow. See what I've done here? The way you do that is hover over top of the symbol once it's compared or overlaid, and just click on the eyeball and it'll hide it, but it's still there. If I want to make it come back, I just hit the eyeball here. But what I'm plotting here is the E-mini S&P, which is the darker blue line, versus the NASDAQ futures. The low here relates to this one. This lower low in E-mini S&P shows the lower low matched with the NASDAQ. So is there any divergence there? No. Doesn't give us any kind of intel whatsoever. Now, if I look at the NASDAQ compared to the Dow at that same time, now we can see the divergence. We can see that crack in correlation. We can see now smart money is absolutely entering the marketplace when the S&P trades down into that bullish order block. Now you can't see the S&P right now because I've removed it. It's hidden. I've hit the little eyeball here so it hides it. But now if I look at just the S&P with the NASDAQ and the Dow hidden, and then go one at a time, now you can see the contrast between the S&P, and I'll go back to that one. There's the S&P. There's the Dow. And once more, you're focusing on these lows here. Watch how the Dow has the higher low here, and S&P has the lower low. See that? And then finally, we'll go to the NASDAQ, and it clearly has that lower low. So you can see by going through individually, you can see there's absolutely a divergence, which means there's strong accumulation in stocks at that moment. And if the S&P is trading at a bullish order block, that means it's qualified for a long. So back to that range area and back into candlestick mode, you can see how that lower low in S&P wasn't a break of support to go lower. It was absolutely accumulation at the lower end of that bullish breakers range. So it was in a deep discount market. It has already taken out sell stops here and returned back to an imbalance there. So if we look at it with this level here highlighted, so if we see this level being traded back down into here, and we're treating that as that hourly order block, it'll stand out if we go out to a higher time frame chart. So here we are in the daily chart, and you can see inside that daily range here, here's those levels. This is the buy side liquidity pool, the initial one. This is the fair value gap discount low, the fair value gap premium high, and the higher buy side liquidity pool here. That entry was down here. Remember, I drew that red line on the order block on the 5-minute chart with the red line right there, and that's how the range reacted as a result later. Notice that you're also inside of this range here. What's going on there? Bullish order block. So you have the bullish order block, it trades down into here. That's your underlying narrative, and it's going to run to what? This buy side liquidity on the daily chart. And maybe, if not today, the next day or the day after, it would likely pull up into this area here. This is how you take institutional order flow and apply it to indices or stock indices. It's basically the same thing I do with Forex, but I just don't include a lot of the things that are very characteristic of Forex, like the 20s, 80s, and 50 levels. You don't have to worry so much with that with stock indices. It's basically look where the stops are and whole numbers, like around 10 levels, like 39.60, 39.70. 10 handles is a significant factor. If you move 50 handles, which would be equivalent to like 39.50 to 4,000, that's a significant move too. So just be mindful that's how the indices operate. And you can actually split that down into smaller quarter points because indices are delivered in 0.25, 0.50, 0.75, then whole number. That's the pricing for this asset class. But you can see it gets really close to what we would expect to do what on a Power 3. If we're expected to see bullish prices, we want to be buying at the open or below it or very close to it. That red level here is again there on the 5-minute chart. So it's trading right there with that divergence I outlined moments ago. Back to the daily chart, all the framework here is applied from the lower time frame, now applied to the daily chart. So I'm working both directions, from top down and then from intraday up to the daily. So you can see all the framework here. And here's the 4,000 level. I think we'll hit that. All right, so again, let's go into that lower time frame chart, and you can see now, looking at it on a naked basis, it's hard to see anything like that. You have to strip it down, do some deep research behind price action and why it's doing what it's doing. Because if you look at the price just like this, it tells no story, it tells no narrative. If you're just looking at patterns, okay, you have to look at the institutional order flow. Why should it be moving higher? Why should it be moving lower? What's it going to draw to? What's its draw on liquidity? What's the next pool of liquidity it's going to pull up to or down to? And then you look for reasons to support the idea of a market that is under manipulation. And that's what I've shown you here. And it's not much different from what I show when I'm teaching the correlated pair SMT, divergence between euro and cable. One fails to make a lower low when the dollar makes a higher high. That's the same thing that's occurring here, where I'm comparing and contrasting the NASDAQ, the Dow, and the S&P futures contract with, now here's the thing, if you just go in here and start looking for divergences, because this is what's going to happen, because people are going to assume that all you have to do is wait for them to diverge. Notice that the divergence was not even considered until the underlying premise was outlined with this fractal. We ran sell side liquidity, we ran back to an imbalance here, we're inside of a bullish order block from the 60-minute chart. Then if it's trading down into that level, let's take an x-ray view inside price and see, is there really accumulation going on? And as long as you have one indice failing to make a lower low, you have it. That's your smart money fingerprint that just says, okay, it's about to go up. And then here you are. That's how it delivered. Right inside there was your homework. And now your homework's been reviewed. Until I talk to you on Monday, be safe. All right, we're going to do some Spoze trading here. It's an example from March 10th, 2020. This is me trading live through TradingView. You can only do this if you pull live data from their platform. You can't do any kind of trades like this unless you have a live feed. But I'm going to show you what it looks like once you know what you're doing, and you can take small intraday trades using institutional order flow. The market's coming back down into that bullish order block, the two down close candles here, and has repelled away from that. Now we're going to be reaching up into that 2882 level.